What you're about to hear might sound impossible, but I need you to stay with me because the evidence is overwhelming. Right now, at this very moment, there's a wealth protection strategy that thousands of American retirees are using to shield their hard-earned savings from what's coming next. And the window to act is closing faster than most people realize. Let me paint you a picture of what's happening behind closed doors. While mainstream financial media keeps telling you everything is fine, there's a completely different story unfolding in the vaults of central banks, in the trading floors of major institutions, and in the quiet accumulation patterns of the world's wealthiest families. They're moving massive amounts of capital into physical precious metals, and they're doing it with an urgency that should make every American retiree sit up and pay attention. Here's what most people don't understand. The financial system we've all trusted for decades is built on a foundation that's showing cracks. Not small hairline fractures, but deep structural faults that threaten the purchasing power of every dollar sitting in your retirement account right now. The currency you've worked your entire life to accumulate is being systematically devalued, and the pace of that devaluation is accelerating. Think about this for a moment. When you started working, what could a dollar buy? Now fast forward to today. That same dollar buys a fraction of what it once did. But here's the terrifying part. The rate of currency debasement we're seeing now makes the past look tame by comparison. The money printing, the deficit spending, the expansion of the monetary base, it's all happening at a scale that has no historical precedent in peacetime. Central banks around the world are buying gold at the fastest pace in decades. Not just any central banks, but the ones that understand monetary policy better than anyone. They're converting their dollar reserves into physical metal, and they're doing it quietly, methodically, and with increasing urgency. When the institutions that literally create money are moving out of paper currency and into hard assets, that should tell you something profound about what they see coming. Let me share something that happened recently that perfectly illustrates this point. A major European central bank, one that had been selling gold for years, suddenly reversed course and became a net buyer. Not just a small buyer, but one of the largest accumulators in their region. When asked why, their official statement was carefully worded, talking about portfolio diversification and risk management. But if you read between the lines, if you understand what they're really saying, it's a warning signal about the stability of the current monetary system. The same pattern is playing out across Asia, the Middle East, and even in countries that have traditionally been strong dollar supporters. They're all moving in the same direction, away from paper promises and into tangible assets. This isn't coincidence. This is coordinated preparation for a monetary reset that most ordinary Americans don't even know is coming. Now, before we go deeper into what this means for your retirement, I want to mention something quickly. I've put together a free guide that breaks down the savings secrets thousands of American retirees are using to protect their wealth. It's in the description below. This guide shows you exactly what's happening and what you can do about it. Grab it while it's still available because the information in there is time sensitive. Let's talk about what's driving this unprecedented move into precious metals. It starts with understanding the difference between currency and money. Currency is what we use every day, those paper bills and digital numbers in your bank account. Money is something that holds value over time, something that can't be created out of thin air, something that has intrinsic worth. Gold and silver have been money for 5,000 years. The dollar has been currency for about 50 years since we left the gold standard. That distinction matters more now than ever because we're living through the largest monetary experiment in human history. Never before have all major currencies been completely unbacked by anything tangible. Every dollar, every euro, every yen exists only because a government says it has value. There's no gold backing it, no silver, no commodity, nothing but faith in the system. And that faith is being tested in ways we haven't seen since the Great Depression. The supply and demand dynamics in the precious metals market are reaching a critical inflection point. On the supply side, we're seeing production challenges that most people aren't aware of. Major mining operations are struggling to maintain output. The easy-to-reach deposits have been exhausted. New discoveries are rare and expensive to develop. The lead time from discovery to production for a new mine can be a decade or more. Meanwhile, existing mines are depleting faster than new ones are coming online. But it's the demand side where things get really interesting. Industrial demand for silver in particular is exploding. Every solar panel requires silver. Every electric vehicle uses significantly more silver than traditional cars. The green energy transition that governments worldwide are pushing requires massive amounts of silver, and there's no substitute that works as well. We're talking about industrial consumption that's growing exponentially while supply remains constrained. Then you have investment demand, which is surging as more people wake up to what's happening. Exchange-traded funds backed by physical metal are seeing record inflows. Retail buyers are purchasing coins and bars at levels that are straining the capacity of mints worldwide. And remember those central banks I mentioned? They're buying at a pace that's absorbing a significant portion of annual production. Here's where the math gets uncomfortable for anyone not positioned correctly. Annual silver production is roughly 800 million ounces. Industrial demand alone consumes more than half of that. Add in investment demand, central bank buying, and jewelry fabrication, and you're looking at a market where demand exceeds supply by a significant margin. The deficit is being filled by above-ground stockpiles, but those stockpiles are finite and shrinking rapidly. What happens when those stockpiles run out? What happens when industrial users who need silver for manufacturing can't get enough? What happens when investors realize there's not enough physical metal to satisfy demand? The price has to rise. Not might rise, has to rise. It's basic economics, and the setup we're seeing now is more extreme than anything in the historical record. Let me take you back to a moment in history that rhymes with what we're experiencing now. In the late 1970s, inflation was raging, confidence in the dollar was collapsing, and precious metals went on a run that shocked the world. Gold went from $35 an ounce to over $800. Silver went from $1.50 to $50. People who had positioned themselves in physical metals before that move protected their wealth and then some. Those who waited, who thought they had more time, watched their purchasing power evaporate. But here's what's different now. The monetary imbalances we're dealing with today are far larger than they were in the 70s. The amount of debt in the system, both government and private, is multiples higher. The money supply has expanded to levels that would have been unthinkable back then. The potential for currency devaluation is not just higher, it's exponentially higher. And unlike the 70s, we now have a global economy that's far more interconnected and far more fragile. Supply chains that span continents, financial systems linked by instantaneous digital transactions, geopolitical tensions that could disrupt trade flows at any moment. The risks are compounded, and the potential for a crisis that cascades across multiple systems simultaneously is very real. Speaking of geopolitical tensions, let's talk about what's happening on the world stage because it directly impacts the value of your retirement savings. The dollar's role as the world's reserve currency is being challenged in ways that seemed impossible just a few years ago. Countries that have traditionally conducted trade in dollars are now making deals in their own currencies. Oil, the commodity that has been priced exclusively in dollars for decades, is now being sold in yuan, in rubles, in other currencies. This de-dollarization trend is accelerating, and every time a major trade deal is conducted outside the dollar system, it reduces demand for dollars globally. When demand for dollars falls, the value of the dollar falls. When the value of the dollar falls, everything priced in dollars, including your retirement savings, buys less. It's a slow-motion devaluation that most people don't notice until it's too late. The BRICS nations, Brazil, Russia, India, China, and South Africa, are actively working to create alternative payment systems that bypass the dollar entirely. They're talking about a new reserve currency backed by commodities, including gold. Whether that specific plan succeeds or not is almost beside the point. The fact that major economies are openly discussing alternatives to the dollar tells you everything you need to know about confidence in the current system. China has been particularly aggressive in accumulating gold. Their official reserves show steady buying, but many analysts believe their actual holdings are far higher than reported. They're not just buying for their central bank, they're encouraging their citizens to buy. They're importing massive quantities through Hong Kong and other channels, and they're developing a gold-backed payment system for international trade. This is not the behavior of a country that believes the dollar will remain dominant. Russia, after being cut off from dollar-based payment systems, accelerated their move away from dollar reserves and into gold. They've linked their currency to gold, they've offered to sell commodities for gold, and they've made it clear they view gold as superior to fiat currency for settling international trade. When major commodity exporters start demanding payment in gold instead of dollars, the implications for dollar holders are severe. Now let's bring this back to what it means for you personally. If you're a retiree or approaching retirement, you've spent decades building your nest egg. You've saved diligently, you've invested wisely, you've done everything the financial advisors told you to do. But here's the uncomfortable truth. If all of your wealth is denominated in dollars, if it's all in paper assets that can be devalued by monetary policy decisions you have no control over, then you're exposed to a risk that could wipe out decades of hard work. The traditional 60-40 portfolio, 60% stocks, 40% bonds, was designed for a different era. It was built on the assumption of relatively stable currency values, moderate inflation, and a financial system that wasn't over-leveraged to the breaking point. Those assumptions no longer hold. Bonds are getting crushed as interest rates rise to combat inflation. Stocks are vulnerable to a recession that many economists see as inevitable. Where's the safety in that portfolio? This is where physical precious metals come in, as a hedge, as insurance, as a way to protect a portion of your wealth from the monetary chaos that's unfolding. Not as a speculation, not as a get-rich-quick scheme, but as a time-tested store of value that has survived every currency collapse, every financial crisis, every empire's rise and fall throughout human history. Here's something most financial advisors won't tell you because they can't make commissions on it. Physical gold and silver in your possession or in a secure allocated storage facility is an asset that exists outside the banking system. It can't be hacked, it can't be frozen, it can't be devalued by a central bank decision. When you hold physical metal, you own something real, something tangible, something that has value, regardless of what happens to paper currencies. The wealthy have understood this for generations. Old money families, the ones that have preserved wealth across centuries, always hold a significant portion of their assets in physical precious metals. They don't put everything in metals, but they make sure they have enough to weather any storm. They've seen currencies come and go, they've seen financial systems collapse and rebuild, and they know that gold and silver are the ultimate insurance policy. Let me tell you about a conversation I had with a wealth manager who works with ultra-high net worth families. He told me that in the past few years, he's seen a dramatic shift in how these families are positioning their wealth. They're moving significant percentages into physical metals, into real assets, into things that can't be printed or digitized away. These are people with access to the best financial advice money can buy, and they're voting with their capital in a very clear direction. One family he works with, worth hundreds of millions, recently converted 20% of their liquid net worth into physical gold and silver. Not mining stocks, not ETFs, but actual bars stored in secure vaults. When he asked why such a large allocation, the patriarch of the family said something that stuck with me. He said, "I've lived through enough crises to know that when everyone thinks the system is stable, that's when you need to prepare for instability. And right now, everyone thinks the system is stable." That's the paradox we're living in. Most people feel like things are relatively normal. Sure, inflation is higher than we'd like, and there are some economic concerns, but nothing that feels like an immediate crisis. But that's exactly how every major financial crisis has started. Everything seems fine until suddenly it's not, and by the time the crisis is obvious to everyone, it's too late to protect yourself. The mechanics of how a currency crisis unfolds are well documented. It starts with a loss of confidence, usually triggered by some event that makes people question the stability of the system. That loss of confidence leads to people moving out of currency and into hard assets. That movement accelerates the currency's decline, which causes more people to panic, which accelerates the decline further. It's a feedback loop that can spiral out of control very quickly. We saw this play out in Venezuela, where people who had their savings in bolivars watched their purchasing power evaporate almost overnight. We saw it in Argentina, in Zimbabwe, in Weimar Germany, in countless examples throughout history. The pattern is always the same. The government prints too much money, confidence collapses, and the currency becomes worthless. The only people who preserve their wealth are those who got out of the currency and into hard assets before the collapse became obvious. Now, I'm not saying the dollar is going to collapse overnight like the bolivar did. The dollar is the world's reserve currency, and that gives it more staying power than most currencies. But staying power doesn't mean immunity. It just means the decline might be slower, more gradual, but ultimately just as devastating to your purchasing power if you're not protected. Think about what's happened to the dollar's purchasing power just in the last few years. The official inflation numbers, which most people believe understate the real rate of inflation, show double-digit cumulative losses. That means if you had $100,000 in cash 3 years ago, it now buys what $85,000 or $90,000 would have bought back then. You didn't spend any of it, but you lost 10 to 15% of your purchasing power just by holding dollars. Now project that forward. If that rate of inflation continues, and there's every reason to believe it will given the monetary policies being pursued, what will your retirement savings buy in 5 years? In 10 years? The math is sobering, and it's why so many people are looking for alternatives that preserve purchasing power over time. Quick aside here, and this is important if you're sitting on $100,000 or more in retirement accounts. I've put together a comprehensive guide on how gold IRAs work. It's in the description below. This guide covers how you can get physical gold into your retirement account without triggering tax penalties, how the process works, what the costs are, and what you need to know to make an informed decision. If you're concerned about protecting your retirement savings from what we're discussing here, it's worth checking out. No obligation, just information that could be valuable for your situation. Now, back to the bigger picture. Let's talk about the supply situation in the physical metals market, because this is where things get really interesting. There's a growing disconnect between the paper price of metals, what you see quoted on financial websites, and the price of physical metal that you can actually take delivery of. This spread, this premium over spot price, has been widening significantly. What does that tell us? It tells us that there's more demand for physical metal than there is supply available at current prices. When you go to buy coins or bars from a dealer, you're often paying substantial premiums over the spot price. Those premiums have been rising, and in some cases, certain products are simply unavailable regardless of price. That's not normal market behavior. That's a sign of a market under stress. The COMEX, the exchange where gold and silver futures are traded, has seen some unusual activity recently. The amount of metal standing for delivery, meaning people who are taking physical possession instead of just rolling their contracts forward, has been increasing. Normally, the futures market is used for price speculation, not for actual delivery of metal. But when more people start demanding delivery, it puts pressure on the exchange's inventory. There have been moments where the COMEX has had to scramble to find enough metal to satisfy delivery demands. They've changed rules, they've offered incentives for people not to take delivery, they've done everything they can to keep the paper market functioning. But here's the thing, if enough people demand physical delivery, if the market loses confidence in paper claims on metal, the whole structure could break down very quickly. Imagine what happens if a major institution, a hedge fund, or a sovereign wealth fund decides they want to take delivery of a large position. Imagine if they demand physical metal and the exchange can't deliver. The loss of confidence in the paper market would be immediate and severe. The price of physical metal would spike as people rush to secure real metal instead of paper promises. And anyone holding paper claims would find out very quickly that their investment isn't worth what they thought it was. This is why the distinction between physical metal and paper claims on metal is so critical. When you own physical gold or silver, you own the actual asset. When you own a futures contract or shares in an ETF, you own a claim on metal that may or may not actually exist in the quantities promised. In normal times, that distinction doesn't matter much. But in a crisis, it's the difference between having real wealth and having a piece of paper that might be worthless. The industrial demand story for silver deserves more attention because it's a factor that doesn't exist for gold. Gold is primarily a monetary metal and a store of value. Silver is both a monetary metal and an industrial commodity, and that dual nature creates unique supply and demand dynamics. Every year, industrial applications consume hundreds of millions of ounces of silver. Much of that silver is used in applications where it's not economically recoverable. It's gone, permanently removed from above-ground stockpiles. Meanwhile, new mine production isn't keeping pace with demand. The deficit has to be filled from somewhere, and that somewhere is existing stockpiles that are finite and shrinking. The solar industry alone is projected to consume massive amounts of silver over the next decade. Each solar panel requires silver for its electrical conductivity, and there's no substitute that works as well at a comparable cost. As countries push for renewable energy, as solar installations increase, the demand for silver from this one industry could absorb a significant portion of annual production. Electric vehicles use substantially more silver than traditional internal combustion vehicles. The electrical systems, the battery management, the various electronic components all require silver. As EV adoption increases and every major automaker is betting heavily on EVs, the demand for silver from the automotive industry is set to explode. Then you have 5G infrastructure, medical applications, electronics manufacturing, and dozens of other industrial uses that require silver's unique properties. All of this demand is growing, and it's growing at a time when mine production is constrained and above-ground stockpiles are declining. The math doesn't work unless prices rise significantly to either incentivize new production or ration demand. But here's where it gets even more interesting. Unlike most commodities, where higher prices quickly bring new supply online, precious metals mining has long lead times and high capital requirements. You can't just decide to open a new gold or silver mine. It takes years of exploration, permitting, development, and construction. By the time new supply comes online, the market dynamics could be completely different. This supply inelasticity means that when demand surges, prices can move very quickly and very dramatically. We've seen this pattern play out multiple times in history. Prices stay relatively stable for years, then suddenly explode higher as supply constraints become apparent. The people who position themselves before that move benefit enormously. Those who wait until the move is obvious end up paying much higher prices for the same protection. Let's talk about the historical parallels, because understanding what's happened before gives us insight into what might happen next. Every major currency debasement in history has been followed by a surge in precious metals prices. It's not a coincidence, it's cause and effect. When currencies lose value, people flee to assets that hold value, and precious metals are the oldest and most trusted store of value humanity has ever known. In the 1970s, as I mentioned earlier, we saw gold and silver multiply many times over as inflation raged and confidence in the dollar declined. But that wasn't the first time, and it won't be the last. Go back further to the 1930s during the Great Depression. The government revalued gold from $20 an ounce to $35 an ounce, a 75% increase overnight. People who held gold saw their wealth increase dramatically in dollar terms while everyone else struggled. Go back even further to the collapse of the Roman Empire. As Rome debased its currency, mixing more and more base metal into its coins, the value of pure gold and silver soared. The wealthy Romans who held precious metals preserved their wealth through the collapse. Those who held debased currency saw their savings become worthless. The pattern repeats throughout history because human nature doesn't change. Governments always overspend, they always print money to cover their debts, and they always debase their currencies. And every time they do, precious metals preserve wealth while paper currency loses value. It's happened so many times that it's not even a question of if it will happen again, only when. Right now, we're in the early stages of what could be the largest currency debasement in history. The amount of money that's been created in the last few years is staggering. The debt levels are unprecedented. The fiscal deficits show no sign of shrinking. Every indicator that has preceded currency crises in the past is flashing red right now. And yet most people are going about their daily lives as if nothing is wrong. They're trusting that the system will continue to function as it always has. They're assuming their retirement savings will be there when they need them, with the purchasing power intact. But history shows us that's a dangerous assumption to make. The question you need to ask yourself is this: what if the people who are warning about currency debasement are right? What if the central banks, the wealthy families, the institutions that are accumulating precious metals know something that the average person doesn't? What if the next few years see a monetary reset that fundamentally changes the value of paper assets? If that happens, and you're not positioned correctly, the consequences for your retirement could be devastating. You could watch decades of savings lose half their purchasing power or more. You could find yourself unable to maintain your standard of living. You could be forced to make choices you never imagined having to make. But if you take action now, if you position a portion of your wealth in physical precious metals, you create a hedge against that scenario. You give yourself insurance that protects your purchasing power regardless of what happens to paper currencies. You join the ranks of the wealthy and the institutions who understand that real wealth is measured not in currency units, but in tangible assets that hold value over time. This isn't about putting all your eggs in one basket. It's about diversification in the truest sense. It's about recognizing that having all your wealth in dollar-denominated paper assets is actually a concentrated bet on the stability of the current monetary system. Adding physical precious metals to your portfolio is how you reduce that concentration risk. The mechanics of how to do this are straightforward, but there are important details to get right. You want physical metal, not paper claims. You want it stored securely, either in your possession or in allocated storage where you have clear title. You want to work with reputable dealers who have track records and transparent pricing.